Hey traders, this is Blake Morrow with Trader Summit, and I have with me Bill Baruch from Blue Line Futures. Good to see you, Bill.
Good to see you. Thanks for having me on today.
Yeah, you're actually unshaven, and I think that happened because the market has been so volatile the last 48 hours. You haven't been able to shave. Am I correct?
Yeah, it keeps you busy. That and three kids at home, and just kind of juggling one thing to the next. So I typically, it's the last thing I really want to think about.
Well, usually for me, if I miss shaving, it's usually because the markets are so volatile. And then the good news is with me being almost 50 and half Chinese, even if I shave or don't shave, no one can tell anyway. But anyway, hey, I just want to say, the last 24 hours, because of what happened with the FOMC, the moves in the market, we've seen a lot of just crazy moves. We've seen yields scream to highs. We've seen stocks give up all their gains from yesterday. We've seen the dollar carting people out, myself included. You've seen some big moves in precious metals and even cryptos. What do you make of the last, let's just say 24 hours, 36 hours of price action, especially following the Fed? And what are your thoughts?
Well, as we know, markets like to bring the most pain to the most number of people. And, I think it even is a little bit of a reflection of that on, it's been very orderly sell off in equities to some degree. There was some panic on Monday. We came pretty close to that 40-30 area, which was a gap from April of April of last year where we broke out. And, we knew a lot of people were looking at that. So we were expecting a bounce, but it certainly made it difficult for anybody that was trying to hold on to longs there. But even just looking at a micro sense, yesterday before the Fed meeting, the equity market, the S&P went down and took out the previous day's lows and took out the session highs and then proceeded to have an extended volatility. So, looking at what we're seeing here today, the S&P ran up, couldn't get above 4303, and now we're back below yesterday's low. And that just sort of echoes everything that you're seeing, where you mentioned that the dollar rolled over yesterday, and now it's ripping higher. So there's a lot of movement across markets right now that it's just making it very difficult on anybody to really stick to what their theme is and the positions that they want to hold and continuing to audible.
Did the Fed chairman? I mean, look, we raised rates half a basis point, and it looks like we're going to do it again, here in the next meeting. So, did the Fed chairman sound dovish to you? I mean, did you fall for it? Like you saw stocks ripping yesterday. Did you fall for it there?
We've been long in the equity market. So as just recently, as in previous conversations, I think we've touched on it where I've been very negative this year, been very negative, hedged in wealth portfolios and really trading the S&P and equity markets from the short side. And it's been really well for us. And when last Monday went down to 4,200, I started changing my narrative. Okay, there is a measured downside at this point. And that measured downside is if you can be patient and you build your positions between here and 40-30, I think we're going to have a nice run from here. And, so everything really fell in line with what we expected upon that happening. And on Monday's reversal, we also had a relative strength thrust and the cues against the consumer staples. And if you go back to the previous Monday, when we rallied, 100 points off the low, and Thursday we rallied something like 100 points off the low, that relative strength thrust did not happen, but it happened on this Monday, and it was very similar to February 24th and March 8th. March 8th ended up obviously chopping down to March 15th a bit. So maybe what we're seeing today is a bit of a choppiness to build out to March 15th. But I think it's important to note that, where the consumer staples took a hit, potentially you're seeing, some cash being raised that's going into, buy tech. Now, obviously, China's in lockdowns and other issues that are going on in the US dollar can weigh on consumer staples. So there are other things taking place, but the pattern is extremely similar to the extraordinary bottom that we saw put in place on March and had a extraordinary rally. So those are all things that we were looking at coming into yesterday and had positioned for the move higher. And yeah, it just really stalled pretty quickly. We sort of put a little bit of a victory lap out on our morning note today, but did note the fact that if we went below in the stock market in the S&P, and if we had gone back and taken out about 4230, then all bets are off again. So we're back into this choppy range, and I'm upbeat because have been hedged extremely well this year, and we've been able to make money on the future side as well. So It's been a good year so far, and we're just trying to stay patient amid this volatility that doesn't want to keep you patient.
So my takeaway from what you're saying here is that the market's in the process of trying to develop some sort of tradable bottom, and you still think we're in a range. Do you think the 200-day moving average in the S&P 500, which I'll look specifically, I know it's above 4,400, maybe closer to 4,600, but you look at the S&P, and I'm just going to view it really quick. 200-day moving average comes in right around 44.99, I think is what it comes in today. So do you think that we can still make a move back up to the 200-day moving average at least?
I think we'll see that this year. It's going to be from the Fed, kind of, I might have talked around your previous question, but I do think that they were somewhat less hawkish than expected, but I think risk assets had to anticipate for a more hawkish Fed, and that's where sort of the offsides move had come. Now, I do anticipate them to sort of stay in line with what Fed Chair Powell had said, being a 50 basis point hike yesterday. I think right now you're seeing the rate market say potentially a 75 basis point hike again in June. That could erode. I mean, the rate market has been a little bit odd the day or two after the Fed meeting, so maybe that could settle in. But my anticipation in kind of tying that into retesting the 200-day moving average is the fact that I think everybody's really, really hawked up on inflation right now. And when you start seeing the magazine covers printed, it usually is a theme that's towards the end. Now, I'm looking at the core CPI for March was 6.6%, I believe, and that was contained within expectations. The base comparison for 2021 for those numbers was 1.4%, and that was an average of quarter one 2021. Now, if you look at June through August, we have average core CPI at 4.3%. So, I mean, effectively, what are we at? Like, that means effectively like a 3.7 if we have no inflation from here. Asset prices have come in pretty well since March. Stock market has. Look at copper down 10%, wheat down 10%. So there are things, obviously housing, I think, is cooling. There's going to be some question marks about the supply chain bottlenecks, but the Fed, and like Powell said yesterday, they can't control these supply chain bottlenecks. So there's going to be inflation tailwinds that do keep it up, but I think it's going to be much calmer than most people expect here by August. And that's where I'm really upbeat and thinking that this is a time to accumulate positions in the equity market and know your downside, manage your risk, but can you measure your downside is the big question. Because if this plays out, I think you could see the reaction from the Fed yesterday and as well in March. I think we could be making a run back above 4,500 and towards potentially record highs in August through October if this plays out the way I would expect.
Sounds good. And I know I wanted to really talk a little bit about precious metals here in a second, and because gold, you and I have talked about gold and silver quite a bit in the last couple of times that we've talked. But before we do that, I just want to ask you really quick about non-farm payroll. I know by the time people watch this, non-farm payroll is probably going to be passed. We're going to see the market move a little bit. So I don't want to hold your feet to the fire here, but I want to ask you, are the jobs report, we haven't paid a lot of or very close of attention to the jobs report as of late. I know everybody's watching like the wage data, but are you going to start watching that headline number? Is it going to start to matter moving forward for you?
Well, the job openings picked up, and I think there was I don't remember the exact number, but there was a lot of people who quit their job. And that has been a tailwind to more job openings. So, yeah, I think it's important to keep a pulse on the economy for that job number and to see at least continued growth. You don't want to see growth erode in that aspect of it. But yeah, the wage growth, the average hourly earnings of individuals, that's going to be pretty crucial, because that's going to be an inflation tailwind if that continues to pick up. So I think it is overall important. But I'm looking at it as, I think it's more likely that we could find ourselves in some Goldilocks scenario if the wages just remain calm and the job growth is lukewarm, but at least solid. So I think it could be a positive tailwind tomorrow. But if the market closes today, it's less about jobs, and if we start to see a severe negative gamma breach, which would the S&P closes below 4,100. I mean, there's really not much on a data point that's going to really stop it at that point potentially.
That makes a lot of sense. Okay, well, we'll pay attention to that tomorrow. Like I said, everybody that's watching this right now is watching post non-farm payroll anyway, just as a warning. Now, I want to talk a little bit about precious metals because, to be perfectly frank with you, they have not traded very well. I mean, in recent weeks. I mean, we look at gold, and gold's actually, come off here. This is a weekly chart in gold. We've seen it sell off over the last few weeks. What do you make of this move in gold? I mean, is this part of the narrative that inflationary pressures are coming off, or are you a buyer here? What do you think with gold?
I look at gold through two lenses, and I look at it as having it as an investment, and I look at it as a trading vehicle. Having it as an investment, I mean, I hear a lot of people these days saying, gold is the gold bugs have not gotten what they wanted, and gold bugs have left it empty-handed. Whatever the narrative on that is, I think that's wrong. I think if you look back, what has gold done since the pandemic started, and since 2019, when the economy was fears of the slowing? Gold has had a tremendous run since then. And I think that can't go unnoticed. If you have a proper allocation to gold in your portfolio, it's done exactly what it needed to do, and it's gone up and it's hedged. Now, if you unfortunately had bought gold at the highs in 2020 or chased it higher, near 2000 this year, yeah, you're going to be in a very tough situation right now. And my narrative for gold has always been, you don't want to be buying gold when everybody's screaming for it. You want to be buying gold, when you want to be selling gold when everybody's screaming for it. You want to be buying gold when it sells off. And right now, I'm looking at, from a trading perspective, is it holding some constructive support levels? And it really battled very well at 1858. And I want to see it remain constructive, because the longer term, the decade trend that I think you're showing right now is building this beautiful sort of cup and handle formation, and it's rounded out bottom. It's a nice big smile, and now the handle is being formed. And I think if it can remain constructive, there's tremendous upside from here, because at some point, the old saying goes, and that's something I've been talking about, is the US dollar likes to top at the onset or early stages of a hiking cycle. And it's been a tailwind to gold, and rates top at the onset or early stages of a hiking cycle, because really the expectations get really front loaded. Now, we've seen gyrations recently, obviously, with the dollar storming back today, or rates storming back today. The Treasury is just a bloodbath in the Treasury market. And that really just ties more into what's going on in the peers of the US dollar. I mean, the British pound is taking a hit. It was that meeting by the Bank of England was just as messy as it gets. There was dissension. There was, really no coordination there. And they raised 25 basis points, but their really economic expectations have eroded. So I think that's been difficult. And the EU, I mean, they haven't really had much coordination as either. So the dollar is trading against some very, very unsavory peers right now, and that's the problem. So I think as these expectations continue to change, inflation's been a tailwind. The inflation tailwinds have also been a tailwind to the US dollar, because the expectations for the Fed's hiking have had to continue to change a bit. But I think we're in, kind of going back to our conversation earlier on here, was the Fed is sort of, in that peak hawkishness stage. It's just a matter of between now and June, what the peers sort of do from there. So I'm very upbeat on if gold can hold ground here, and I'm very, I think that it's going to have a good second half of the year. It might just need to wait till that June contract expires. And, I can get into the weeds here right now, but when these contracts expire, it does create some positioning, capitulation, if you will, especially when open interest in gold is much lower than it was 5 years ago. So that's something I'm happy to discuss more, but I think that, we're going to see gold have a pretty solid second half of the year.
All right. Well, I like the setup that you're pointing out here. Tell us a little bit about silver. I mean, because silver, has not performed as well as gold, obviously, in the long term. We're looking at a long-term chart. Silver's, nowhere near the 50 peak that we saw back in 2010. So what do you make of silver at this point?
Yeah, silver's really disappointed, and I'm happy to see it hold above $20. And it's been a really great trading vehicle, and despite it disappointing. And, if you're trading silver, you want to keep a close eye on the 50-day moving average. When it's above the 50-day, it stays above it for a while. And right now we're below it, and it stays below it. So it's been a really good 50-day moving average has been a pretty good benchmark. But holding the levels that it has, 21.5 is the 50% retracement from the pandemic low to that big run to $30 in February of last year. So the Brexit is also at that about 21.25. So that Brexit low, it was a pretty big, a Brexit high was a pretty big high for me to remember. And holding out above there, holding good construction at this 21.5 and out above that is pretty good. But we start closing below $21 in silver, I'd be pretty, I'd be stepping aside from it, and it probably is going to go lower. I might be looking to go short at that point. I can't say that at this point. But the other thing with the currencies is the Chinese yuan, and the Chinese yuan has had, has been hit tremendously. The U.S. dollar has run against the Chinese yuan the most since really 2015, and that was. If the yuan is not doing good things, then China can buy less with their currency, and that's as simple as it gets. And their ability to buy commodities right now is theoretically smaller, but I think China is going to be a big buyer of commodities here in the months to come when they come out of this pandemic. And they're looking at this advantageously and the opportunity to buy commodities if they can weaken them by having these lockdowns. All
right, well, that's it. That's a lot to chew on. And I want to thank you for your views, especially, taking us over to the yuan, because, as a managed currency, we've seen it really weaken over the last couple of weeks. And I think people are looking at it like, is this China a way of managing the float a little bit to take some pressure off and move some of those pressures into different parts of the world by weakening their currency? So it's going to be an interesting story as it does develop. But Bill, I love your ideas. I love the way you think. You think like a trader, even though you own a brokerage firm. You deal with a lot of futures clients. Tell us a little bit about Blue Line Futures and what you guys do over there.
Yeah, Blue Line Futures is we're a futures and commodities brokerage firm, and we put out tremendous actionable research every single day, whether it's my report, the S&P, NASDAQ, crude oil, gold, and silver, or my partners. Oliver Slope writes extensively on the agriculture commodities, and our chief market strategist, Philip Strebel, writes on a broad number of ranges from gold to FX and soft markets. So we put out great actionable research for our clients. You can find us at bluelinefutures.com. We actually just launched a new website and has a tremendous amount of educational material on there on, whether you're new to futures or looking to sharpen your tools and learn, option strategies. So if you want to check it out at bluelinefutures.com, you can sign up for our research and you can check out the educational materials there. We also, not just the futures, but I also am an investment advisor, and I manage wealth portfolios for clients and really helping them get something that's, a lot of people out there, these high growth multiple names. And it's the way we build our portfolios is we take that macro background that I have and be able to establish it and sort of more of an all-weather portfolio. And this is definitely the time that where you want to be in a more all-weather build if you're managing your wealth.
For sure. All right. Well, Bill, I always appreciate you. And guys and gals, if you're watching Bill on YouTube, make sure you give him a thumbs up and subscribe to the channel down below so you don't miss any of our content when we interview Bill and Oliver as well. But I want to say that we are a proud source over at a Trader Summit for putting out Bill at Blue Line Futures, his content every day. So make sure you're visiting our website as well. Bill, thank you so much for spending your time with us traders, and we'll catch up very near future.
Always awesome to visit with you. Thanks for having me.
All right, have a great one. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.